Good morning and welcome to The Street on BNN Bloomberg. I'm Roger Peterson. Thank you very much for joining us. Coming up on the show today, Nate Tuff, CIO and Senior Portfolio Manager at Manulife Investment Management, will be joining us for the hour in 30 minutes. Carl LeBlanc, CEO and founder of MedReady, will be here to tell us about her company and how they use AI to make smarter medical procurement decisions. Also, we want to hear from you this morning on First Call. Call us with your sector questions, and we'll have Nate answer as many of them as he can. And, of course, at the end of the show, the number to call, 1-855-326-6266. We'll open the phone lines in about 30 minutes. And, of course, you can email us, firstcall@bellmedia.ca. Now, some of the stories we're tracking for you in the BNN Bloomberg newsroom. More than a dozen Canadian and Australian pension giants have signed a first-of-its-kind agreement to increase investment between the countries. Under the MOU, funds will cooperate to channel more pension capital into both markets. The Australian fund's statement says the agreement will enable both governments to remove policy barriers and improve the business environment for investment. MDA Space logged higher profit and revenue in the fourth quarter as increased defense spending pushed demand. The Brampton, Ontario-based company's revenue rose 44% from a year earlier, also boosted by its satellite business. The space company says it is benefiting from a partnership agreement to develop and deliver military satellite communications for Canadian forces in the Arctic, as well as a contract from the U.S. Missile Defense Agency. Canada has signed 30 new partnerships with 12 allied countries under the Critical Minerals Production Alliance. Energy Minister Tim Hodgson says the deal will lead to more than $12 billion in spending on mining and processing projects in Canada. He also says secure critical mineral supply chains are a part of national security and sovereignty, adding Canada is creating infrastructure to allow greater mineral processing. And now our top line story. Prime Minister Carney is in Sydney, Australia to talk trade and thank the President of the United Arab Emirates for protecting Canadians amid the unrest in the Middle East. CTV's Abigail Beeman has more.
Good morning, Prime Minister. How are you?
Canada's Prime Minister down under in his first media availability a week into his Indo-Pacific trip, asked about the U.S. and Israel's strikes in Iran.
Prima facie, it appears that these actions are inconsistent with international law.
Mark Carney said Canada supported the U.S.'s initial strike.
We supported that aspect. That is not a blank check.
And Canada backs efforts to stop Iran from getting a nuclear weapon, a position he takes with regret, given this reality.
A nuclear bomb is a massive threat. It would be the biggest threat.
With a reminder international law binds, Carney called for a de-escalation and said Canada can help in that process. It was also the first time Carney weighed in since a government official suggested India was no longer involved in foreign interference in Canada.
I would not use those words. Okay.
He says the official involved won't face consequences and wouldn't explicitly say whether he believed India is still actively interfering.
There are aspects of those briefings that I can't share in public, and I'm not going to betray them. I will tell you that there is progress on these issues.
Carney said a wide range of countries will continue to try and interfere from time to time, and Canada will continue to call them out when it happens. Abigail Beeman, CTV News, Sydney.
For more on the war in Iran and the impact on the markets, let's bring in our guest for the hour, Nate Tuff, CIO and Senior Portfolio Manager at Manulife Investment Management. Nate, thanks as always for joining us. I want to get your initial reaction to what Carney had to say today. Some would say he appears to be backpedaling a little bit on his stance from the weekend.
Yeah, thanks. Great being here again. I would say in general, there's a lot of uncertainty around this situation, right? And we wake up in the morning, we have one narrative, and by the end of the day, there's a slightly different narrative. And it doesn't surprise me that we're starting to see more inconsistencies across the globe as it pertains to people's views on how this should evolve and the severity of it. Our key focus has always been, this is about how long the situation lasts. It's how deep the escalation of the situation is, and it's how impactful it is to infrastructure. all three of those lenses are what's key to this situation. And it doesn't surprise me that geopolitical leaders around the globe would like to keep all of those to the most minimum possible scenario. People don't want destruction of infrastructure. People don't want this to go on forever. And we don't want this to escalate further than it's already escalated within the region and beyond. And I think those are the key areas that we all need to think about. And I know political leaders across the globe are all focused on how do we shorten or minimize each of those three lenses.
And we're going to talk more a little bit about those things and how they may do. But with Carney himself, Canada's walking a very fine line with the U.S. as well. I mean, we can't be perceived as going up against them in this, yet we're trying to branch out around the world. Does it feel like Carney is succeeding there with that? That he's not going to upset the apple cart that is the U.S., but also open us up to more opportunities elsewhere?
I mean, I think this is the case with a lot of geopolitical dynamics right now. One of our key themes that we've been talking about is this idea of geopolitical fragmentation. And many countries beyond just Canada are looking to create new relationships and new opportunities for their country. This is not a situation where it's just the U.S. trying to go on their own. Because of the U.S.'s actions in many cases, we are seeing a lot of geopolitical leaders across the globe look for ways to increase the trade environment, improve the optics and national security dynamics for their own countries. And I think it's not a surprise. And I think the reality is Canada needs to do this in order to make sure they have the pipeline and the right infrastructure in place to be able to make them relevant when it comes to global supply chains and when it comes to increasing the potential growth opportunities within the country and the companies that operate within the country. So to me, this is not a unique situation with just Canada. It is a broad theme that we're seeing across all countries trying to figure out the reordering of the global dynamics.
All right, and now the situation itself. I mean, we had Trump yesterday on social media saying he didn't know how long this could go. The markets reacted in the morning. And they were still down for the day, but they kind of calmed down a little bit. Today, we're looking, I was looking at the futures, they're looking down a little bit right now. We're still seeing massive sell-offs in Asia, South Korea taking a big hit. Are we going to go into do you feel like we'll be going into a bit of a calm now just to see where everything is going?
Unfortunately, I don't think so. I mean, the reality is this could go on for a while, and we are going to see headline risk for the foreseeable future. That doesn't mean necessarily the markets have to just keep going down. We are going to see more general volatility around markets. And we have seen a lot of what I would define as buy the dip mentality, where early in the day, particularly U.S. time markets are down, and they tend to rally as the day goes on. Now, this morning, we saw that happen overnight, right? Markets were down quite a lot, and then they rallied on some more positive news. The news cycle is very focused right now on what is the measurement or the data that we have to define how long we think the situation is going to go on. Whenever there's a news source that comes out or a new idea that comes out that this could be more prolonged, markets react negatively. Whenever there's a news source comes out where this dynamic could be shorter or there's a line of sight to how it could end, the markets react positively. So this is very much focused on the time horizon right now as it pertains to impacting the market dynamics and the volatility of the market.
And the interesting thing, we just showed the markets, the pre-markets, and they're up again. When I looked about 25 minutes ago, they were down. This is just the way that kind of day is going. What about the oil aspect of this? We know the Strait is 20% of the oil goes through there. Trump is trying to put a guarantee on. Is that realistic? And how long can this choke point remain a choke point?
I think the most interesting dynamic about what's happening in the markets related to this activity is what is working versus what's not working as a hedge against the situation. And we saw a lot of asset classes that most people think should work when you have a more risk-off geopolitical dynamic, such as gold did not work very well. Treasuries did not work very well. But the U.S. dollar worked very well, and then oil worked very well. What's happening is there's fewer things that are working, and because there's fewer things that are working, those things are working very, very well as a hedge against this situation that's evolving within the region. And I think oil is the classic example of it. Oil is a good hedge when you're thinking about it as a geopolitical risk that's emanating from the Middle East. And oil is going to have an increased risk premium probably for the foreseeable future because of it. Now, that doesn't mean oil keeps going up in a straight line, but there is going to be a higher embedded risk premium in oil prices for the foreseeable future, in my view, because of the ongoing uncertainty within the region and then more the Middle East more broadly.
Okay, Nate, we're going to have to take a break there, but I know you're here for the hour. Thank you. Appreciate it. Nate Tuff, CIO and Senior Portfolio Manager at Manulife Investment Management. Up next, we'll take a look at the markets before the bell. See how things are shaping up on the markets. Another wild morning. We'll take a look at the U.S. futures. Now, when I looked at them about 25 minutes ago, they were down. But since then, the Secretary of War in the States, Pete Hegseth, has been speaking, and he says, not a mission accomplished situation is one of his quotes, but they are focused and they are winning the war. Now, at the same time, we just got a note out from Scott Bessent from the U.S. that he says the tariff hike, the global tariff hike, 15%, will likely start this week. So for now, we're looking at the futures. You can see the Dow up by 0.3, NASDAQ by 0.62, S&P 500 by 0.4. And then, of course, everything that's happening in Iran still. Asian markets, boy, oh boy, though. Different story there. They got rocked overnight again. Still that strong fear sentiment there. Nikkei off by 3.6, Hang Seng 2%, and CSI 300 1.14. Now, we don't have it up there, but the Kospi in South Korea, it has lost 20% in the last 2 days, including a 12.1% hit today. That's the largest one-day loss ever for the Kospi. Samsung and Hyundai are down 10% apiece. Heading to Europe. And some positive reaction there. Recovery from yesterday. Investors snatching up some deals in travel, luxury, tech, and healthcare. You can see the FTSE up by 0.6, CAC 40 by 0.9, and the DAX up 1.33 right now. The TSX yesterday, after that record close on Monday, where it kind of went against it, yesterday taking a hit, big hit. At one point, it was off by 3.4% intraday, ended up closing down 2.19%. Materials, especially gold, taking the hardest hit. So let's see who some of the movers were. And there were some positive. Thomson Reuters up nearly 6%. It's been on a bit of a rally, still down from its high from last year. But Paramount Resources up 7.5%. And going the other way, New Gold, 10.75%. It was off the pet value on a poor report, off by nearly 11%. And let's take a look at the metals. They're now back into it. At one point, gold was down. Now it's rallying a little, up by 1.6%. Silver on another run. It's up at 86, up 3.3%. And copper pushing towards $6 again, up 1.9 right now. And oil yesterday, of course, for WCS, Western Canadian Select, it jumped 5.23% on the rally. Of course, it has been going the last few days. But today might be a different day. Let's take a look at what West Texas Intermediate's doing here. So you can see it's down, actually, a percentage point, below $74 a barrel after surging over the last couple of days. All right. Joining us for the hour today is Nate Tuff, CIO and Senior Portfolio Manager at Manulife Investment Management. And Nate, you're noticing a shift from what you call the enablers to the beneficiaries of AI. And let's talk a little bit more about that. It seems like it's time. It seems like people want to see what it's actually doing.
I think you're absolutely right. I mean, we've seen this powerful move driven by AI, particularly when it comes to companies that are building out the infrastructure, semiconductor names, the infrastructure plays that are building data centers, et cetera, where now we're seeing a lot more differentiation in AI, and there's a shift towards what we're calling the beneficiaries of AI. These are the companies that are going to be using AI to improve their cost structures, improve their margins, improve their potential growth opportunities, and being much more efficient in how they conduct business. And there's a number of sectors that benefit from that. Healthcare is an example where healthcare companies can benefit from the fact that they can develop drugs more quickly. They can diagnose diseases more quickly and more accurately. They can employ a much better data infrastructure around privacy and security. And so there's a lot of different areas of the market that we think are going to start utilizing AI as a means to improve their businesses. And most importantly, it will allow them to potentially expand margins by doing things more cheaply than they used to be able to do by incorporating AI as a tool into those processes.
Now, are these, would you call them early enablers, or is the product proving that it can work and they're just taking advantage of it?
I think if there is, it's still early from the fact that we're not seeing massive benefits at this stage, but we're definitely seeing deployment of AI into processes. And as we all know, the markets tend to react well in advance of when it actually happens. And so we are seeing early signs that our markets are starting to appreciate the fact that certain sectors will be much bigger beneficiaries and certain companies will be much bigger beneficiaries than others when it comes to using AI. And we can list a whole litany of those areas. We talked about healthcare. Another example is the banking industry. The banking industry has no shortage of data and processing dynamics that can be simplified, and banks are actively trying to do that through AI deployment by making things quicker, more efficient, and more accurate.
And is there a danger, though, of using it too early, or these companies are good? They're smart to be on the front line. Some of the one other sector too as well. You want to get into industrial sector as well. I mean, we look at that as big machines, but how do they see a benefit from AI?
I don't think it's too early. There's always a little bit of a risk around governance and security and those types of things that companies have to think very carefully about when deploying AI. But at the same time, they need to be early because this is a competitive marketplace and you need to compete effectively. Your question about industrials, I think, is a great one because industrials isn't only benefiting from the AI story, it's also benefiting from the fact that we're seeing increased defense spending. We're seeing increases in CapEx related to energy and other types of commodity type of dynamics. So I think the industrial sector is an interesting play where there's a lot of companies that are not just benefiting from potential AI, but they're also benefiting from other things. I would point to the industrial sector as a sector that has the ability to help with the build out of AI. It has the ability to build out robotics, which uses AI. It's also one of the higher quality sectors that's more value oriented and has some of the best ROEs, particularly from a U.S. company perspective, where ROEs are traditionally north of 20+%. And so it is an interesting sector because it's hitting on a lot of lenses right now that the market is favoring.
And is there any one group or company that seems to be taking the most advantage of this and we're starting to see the results of it?
I think there's a couple areas. I mentioned defense. Now, this is partly driven by AI, but also just partly driven by the dynamics that we're seeing geopolitically, right? So the defense space is getting a lot of attention because there's a lot of dollars moving into that space, particularly with fiscal spending increasing globally from a lot of different countries. But when you look at it from more of a pure AI perspective, where I think we're seeing it most is companies that are building the infrastructure that's using AI, such as robotics in the manufacturing space. So there's a number of industrial companies in particular that are helping manufacturers and other supply chain dynamics build out the infrastructure using AI as a component to that, but building the machinery and the technology that allows them to facilitate that. So the two areas that we're most interested in, those companies that are benefiting from that, but also the defense companies that both use AI, but also are getting the benefit of dollars being spent by countries across the globe.
Okay, so where does this leave the tech companies then? I mean, if we're seeing that rotation out, where does this leave them? Are people going to stay with it, or are they going to pull all their money out now? I mean, they had huge capex as planned, right?
Yeah, I think this is where we're going to see a lot more discernment, and we've already seen that. We're now seeing tech companies that are winning, and we're seeing tech companies that are losing. And we've seen no shortage of those over the last year. You look at names like an Oracle example. You look at names like Amazon and Apple and NVIDIA. Some of them have done really well where others have fallen behind a bit. And so that discernment and that differentiation is going to continue in our view. We are advocating to stay neutral to overweight tech companies. We're not advocating to be underweight. But one area that we're starting to move more towards is the companies that also will benefit from AI from a user perspective and from an implementation perspective. And this does include a broader array of companies beyond the early companies that were winning, where we had the NVIDIAs winning because of semiconductors. Now we're going to see other companies continue to win that are actually deploying AI and are viewed to be ahead of the game. Google as an example, and Apple as an example, Amazon as well. So there's a number of other plays beyond just the NVIDIAs in our view when it comes to the tech space looking forward.
Okay, we'll have to leave it there, Nate, but stick around. We've got lots more to talk about. Nate Tuff, CIO and Senior Portfolio Manager at Manulife Investment Management. Next up, we'll talk about why commodities are on his radar. Time to see what's on the radar for Nate Tuff, CIO and Senior Portfolio Manager at Manulife Investment Management. And Nate, you've been watching the metals. Bullion climbed as much as 2%. It's dropped back. It was up. It was down today. I'm not even going to look at it right now and see where we're at after that winning streak that ended yesterday. What's your perspective on gold? And we're going to get into silver and some other options as well. But let's start with gold. What are you looking at with it right now?
I think this is a lot about time horizon. And what I mean by that is we obviously saw gold perform very well over the last couple of years, but then all of a sudden we had this geopolitical event that's happening and gold didn't act as well as you might expect in a risk-off event. And I think there's a number of reasons for that. One, gold doesn't have a yield. Two, it's not just driven by geopolitical risk. And so we had some people that were in gold that made a lot of money that had to delever or sell their positions in gold to offset some of the downfall we saw in other asset classes. And so we saw an interesting dynamic with gold acting not as well as you might expect when we have this geopolitical dynamic going on. But when you stretch it out and look at longer term perspectives, we still very much like gold. The themes that are driving gold over the last 2 years haven't changed with this geopolitical event in Iran. In fact, they're still very prominent. Things like fiat currency concerns, debt concerns globally, inflation risk, geopolitical and supply dynamics. So all of those things are still in place as a broader theme underpinning the potential for gold to still hold up or even continue to go higher in our view when it comes to pricing over the next 12 months.
Any concern with gold? We've seen the U.S. dollar strengthen over the last couple of days. I think it's stalled a little bit today. Where does that fit in with gold?
There's two reasons why we've seen gold act up over the last couple of days. One is the fact that it doesn't have a yield. And so when interest rates went up, which also was a bit of a weird dynamic with a risk-off event, but as treasuries and global bond rates went up, gold underperformed because rates going up doesn't typically help gold prices. But the second theme is the dollar. And so the dollar appreciating is also a negative for gold. Our general view is that longer term, the dollar is probably still in the early innings of a secular decline. That doesn't mean the dollar is going straight down, but we think it's one of the underpinnings of gold continuing doing well over the next, let's say, 5+ years, because we think the dollar will not be as dominant as it has been over the last, let's say, 10 or 15 years. And so the backdrop in our view for gold when it comes to the dollar dynamics is fairly favorable because we think a depreciating dollar is positive for gold prices.
And the Canadian dollar stayed strong, relatively strong to the U.S. over the last few days with what's unfolded. Gold companies here have benefited. Where do they fit in?
I think when you look at gold companies and miners, clearly if we believe that gold price is going to go up, there are going to be a lot of mining companies, particularly the well-run, high-quality companies, that will benefit. And we probably will continue to see some consolidation when it comes to smaller miners being gobbled up by larger ones. And so I think the backdrop from a merger activity perspective, from a price of gold perspective, is still quite favorable for a lot of the mining companies, despite how well they've done over the last 2 years, with this broad underpinning that gold is still very well supported from a price perspective.
All right, and then let's talk silver. Different beast, sort of, not sort of. You got to have a strong stomach for silver, don't you?
You definitely have to have a strong stomach. There are certainly going to be more volatility there and more bigger price swings. But the underlying themes are in many cases the same. I would actually argue that there might be even a bit better because there's also some practical practical uses for silver that doesn't quite as benefit as gold as much. And so our view is that the general direction of silver will rhyme a lot with gold, which is just a lot more variability in the price and a lot more volatility in the price. And so the underpinnings are there for both gold and silver to continue to track well together as a trade. But if you're looking for the safer, more consistent performer, gold is the winner. When you're looking for something that has more volatility or potential upside, silver probably is a game that you might be willing to play from a more of a speculative perspective, but they both have the same underlying pennies as it pertains to the drivers of their prices.
And just quickly before we take a break, any other metals worth looking at for you?
We like copper. I think copper is an aspect that there's a lack of supply or a limited supply. It's hard to bring on more supply. Demand is high. We think global growth rates, particularly outside the United States, will continue to pick up. So emerging market countries wanting and needing more access to copper. So generally speaking, we do like copper and continue to believe that it could track higher in the coming years.
All right, we're going to leave it there, but thank you, as always, for sticking around for the hour. We appreciate it. Still ahead, we're talking to Carl LeBlanc, CEO of MedReady, and, of course, our phone lines will open soon for our first call segment. You can reach us at 1-855-326-6266. Send us an email if you'd like. First call at bellmedia.ca. Prime Minister Mark Carney says his support for U.S. military action in Iran came with regret because the current conflict is another example of the failure of the international order. Speaking at a news conference in Sydney, Australia, Carney's talked about the need to prevent Iran from acquiring nuclear weapons, but added the U.S. and Israel acted without engaging the United Nations.
It's for the United States and Israel to make the case. And for whether or not that is the case. And it's for others, more expert than me, non-lawyered, certainly non-international lawyer, who are more expert to make that determination. And that said, well, Canada was not asked to participate, you know that. We were not informed in advance. We were not asked to participate. Prima facie, it appears that these actions are inconsistent with international law.
Dozen Canadian and Australian pension giants have signed a first-of-its-kind agreement to increase investment between the countries under the MOU. Funds will cooperate to channel more pension capital into the markets. The Australian Funds statement says the agreement will enable both governments to remove policy barriers and improve the business environment for investment. Shares of SSR Mining are soaring in the pre-market, up nearly 16.5%. The American company is selling its 80% ownership stake in the Copper mine in Turkey to Cengiz for $1.5 billion US in cash. Cengiz is one of Turkey's largest industrial companies. SSR Mining plans to use the proceeds for reinvestment, capital returns, and growth initiatives. The deal is expected to close in the third quarter. And taking a look at the markets on the wake of what we heard from the Minister of War, Secretary of War down south of the border, saying that the U.S. is winning this. It's not over yet. The market's reacting in a positive light. Everybody in the green right now. The Dow up a quarter, NASDAQ up more than a half, and the S&P 500 up by 0.3. International Women's Day is coming up, and we are looking at companies led by women changing Canada's economy, including MedReady. It's a Canadian health tech company transforming how hospitals and healthcare systems buy medical solutions. Here to talk about the company's work is Cara LeBlanc, the CEO and founder of MedReady. Cara, thank you very much for joining us.
Thank you very much for having me. It's great to be here today.
Let's talk a little bit. What is the company? What do you focus on, and how did it come about?
Sure. So the company is MedReady is a web-based solution that is enabling the faster acceleration of adoption of medical products and solutions through our strategic procurement platform. And it came about after working in the space for over a decade, doing hundreds of RFPs. I saw how painful and sort of outdated the process was in terms of generating fair and equitable requirements for any kind of medical solution that needs to be purchased for the health system, and wanted to build a better way that enabled a faster adoption of critical products and services that they need.
It's great to meet you. One of the key themes I love about the healthcare sector is it's one of the few sectors that can really compete with tech companies from a growth perspective. But your company intersects the two of them, which I think is fascinating. So how do you think about tech and AI helping you grow your company, particularly to benefit other healthcare companies in your space?
Yes, it's a great question. One of the things that we, in terms of our AI strategy from the beginning, was ensuring that this was an accessible web-based solution backed by an AI model that is powered and grounded in scientific medical journal research, and pulling key millions of data points actually to generate the latest evaluation criteria that's also value-based. And so centered on patient outcomes, health system outcomes, not just specifications, only questions and lowest price, but looking at the total value, because there is a patient waiting at the end of every purchase. So when we built that AI strategy from the beginning with our incredible team, Stephen Fike and Eric Hubner, we ensured that it was built from a global perspective and also generating net new data, because medical technology is changing so rapidly.
And with the AI, how are you fact checking on it? How are you ensuring the accuracy of what you're using with it?
Yeah, we actually leverage a lot of different processes in terms of retrieval augmentation generation, retrieval processes, and medical journal research. So that's a lot of grounding evidence in peer-reviewed studies and clinical evidence.
And obviously, I'm guessing you only see this growing. What more can you do with AI? Where do you see you taking AI within this company?
Yeah, so I think one of the really exciting things is that we've enabled our AI model to account for global growth. So there are obviously different regulatory factors and approval processes in every country. And so we've factored that in so that whether you're buying something in Europe or in the US or in Canada, it's collecting the latest data points and regulatory factors, as well as the latest innovations, so that you're making better informed decisions from the beginning.
And Kara, one way that I think about what you're doing is how do you connect the lines? Because if you're helping supply these types of tools, you have to work with both the end user and the supplier. And so what is the dynamic of negotiation of that and just the intertwining of connecting those two groups and populations?
Yes, so it is. It's a joint effort, right? And so I know on the buyer side, like on health systems, the net new data that's generated for them gives them a completely new starting point, and when they're generating an RFP, an RFI, an RFQ, versus a blank page or a very old document that they've referred to previously. So it really helps to mitigate risk on that side. And then on the supplier side, it enables a new way for them to reach potential customers. It's a new digital marketing channel. They are also facing, changes in their industry on how to go about selling or marketing solutions, and this is a unique way to do that.
And are you seeing the time shortened? And how are revenue? How are sales? And are they growing? And where are you going with that?
Yes, we actually guarantee to save 250 hours per procurement project, and we are growing fast. We're growing rapidly in the U.S. and Europe right now.
And Canada?
And in Canada, of course, yes. Our initial.
Sorry, go ahead, Nate.
I was going to say, when you think about what you're providing, is it mostly focused on the aspects of the diagnostics and the tools, or do you also get involved with drugs themselves and the pharma aspect of things as well?
Yeah, I'm glad you raised that question. We actually just recently launched a new functionality that now can generate evaluation criteria for pharmaceuticals and medications as well. We had previously supported pharmaceutical products and software and services, but now we're moving into the medication space as well, because those also need to be procured for various health systems, clinics.
And now, I mean, you're dealing with the healthcare system. You're dealing with government. Are they seeing that you can find these efficiencies, and are they implementing them elsewhere or using them in different ways?
Yeah, yes, exactly. They are. One of the things that has been really exciting is that they're able to make faster sourcing decisions and identify new potential suppliers that they hadn't been aware of previously. And in addition to that, it's enabling to do more with less, and it's enabling efficiencies in procurement that have long been needed.
Okay.
And what's the biggest risk to your company or the biggest competition aspect of it? And how do you think about that?
Yeah, I think currently I would say probably status quo. There's definitely some changes in methodologies and culture changes and change management that would need to be accounted for because it is a new way of doing things, and there hasn't been a lot of technology innovation in the procurement space. So it's certainly a very exciting time.
Okay, Kara, thank you very much for joining us. We appreciate it.
Thank you so much for having me. It's an honor. Great to be with you today.
Cheers. Kara LeBlanc is a CEO and founder of MedReady. Still ahead, President Donald Trump and German Chancellor Friedrich Merz met on Tuesday to talk trade, but the talks quickly were overshadowed by the war in Iran. Bloomberg's Oliver Crook will have the latest after the break, and our phone lines are open. Top CIO and Senior Portfolio Manager at Manulife Investment Management is taking your sector questions. Call us at 1-855-326-6266. You can reach us by email at firstcall@bellmedia.ca. President Donald Trump and German Chancellor Friedrich Merz met on Tuesday. During the meeting, Merz told Trump he wants the European Union's trade agreement with the U.S. to be implemented quickly, but that the bloc can't accept a deal with worse conditions. Merz also said that the U.S. couldn't impose prohibitive trade measures just on Spain after Trump threatened to cut off all trade with Madrid after the country denied access to its military bases for the American bombing campaign against Iran. Bloomberg's Oliver Crook reports.
Everything gets so sort of muddled up with every geopolitical twist and turn that you get from the United States. You now have this threat from the President of the United States to basically cut off all trade relations with Spain, which of course would complicate the broader trade situation with the rest of the Europeans, which is one of the main priorities that Chancellor Merz had when he was in Washington, D.C. Unfortunately, that press conference, what you couldn't see in that shot is sitting right next to the President of the United States was the Chancellor of Germany, who basically got very few questions from the press. Everything was completely dominated by the question of Iran. And for Friedrich Merz, who arrived in Washington, D.C., he really wanted two things. He wanted to get clarity on the U.S. tariff policy, what the framework was going forward, how on earth the Europeans are going to continue to move forward with ratifying their trade deal with the United States, and of course trying to get into the president's head and understanding on the question of Ukraine and what the next moves for the United States are in terms of trying to further the peace agreement with the Ukrainians. Of course, what ended up dominating the conversation was the question of Iran. Here is the Chancellor of Germany sitting next to the President of the United States and his view on the situation with Iran. Have a listen.
This is, of course, damaging our economies. This is true for the oil prices, and this is true for the gas prices as well. So that's the reason why we all hope that this war will come to an end as soon as possible. And we are hoping that the Israeli and the American army are doing the right things to bring this to an end and to have really a new government in place who is coming back to peace and freedom.
Yeah, something had to be done. And it's been 47 years.
So a conversation between these two leaders that was really hijacked by the question in Iran for the Chancellor of Germany now heading back to Germany and really sort of trying to brief the Europeans in the conversations he had with Donald Trump probably did not make the kind of advances that we'd like to see on the question of trade, on the question of Ukraine. And we should say that the Germans have been a lot more hedged in dealing with the question of Donald Trump, particularly on Iran, much more supportive of the president, though obviously still intensely uncomfortable with some of the developments we've seen over the last 48 or 72 hours.
Still ahead, we'll take a look at some of the notable analyst calls and recommendations moving the markets, including a slew of cuts on pet value. take a look at some of the notable analyst calls and recommendations. Roth Capital Partners initiated coverage of Paramount Resources with a recommendation of buy after the company reported sales that topped estimates yesterday. PT set to 33 Canadian, implying a 12% increase from last price. National Bank Financial initiating coverage of Blue Ant Media with a recommendation of outperform. PT set to $11 Canadian, implying a 79% increase from last price. And after Pet Value reported earnings and sales that trailed estimates, numerous analysts cut their recommendations. Just one of them here, Barclays analyst Adrian Yee cut the target on Pet Value holdings to 28 from 34, maintaining overweight rating though. Barclays moved its target to the low end of the range, implying an 11% increase from last price. When we come back, Nate Tuff, CIO and Senior Portfolio Manager at Manulife Investment Management, takes your questions on First Call. Time for First Call, and first up is the first email, and it's from Sue, and she says, "Good morning, Nate. The airline sector is getting hit again by the current situation in Iran after strikes and other pressures. Do you have any thoughts on the continued disruptions in the airline industry?"
Thanks, Sue, for the question. I mean, the airline industry is a tough industry, and I think the cons outweigh the pros in general when it comes to investing in the space. It's a very capital-intensive business. It's a low-margin business. It's very sensitive to geopolitical dynamics, travel disruptions, as you mentioned, and it's very predicated on a very strong economy and people willing to spend money. Now, there are some positives, but I think if you look at that cost structure and that margin dynamic, it's a tough space to be. And when you have any types of disruptions, such as the Iran conflict, and the international flights in particular tend to be some of their higher margin types of business, that's a problem for these companies. And that's why you've seen some of the travel stocks react so negatively, particularly ones that traffic through the Middle East. And so it's a challenging space. Now, I guess the positive is we know consumers want to use and travel more from a service perspective, and companies on the margin are becoming more efficient at running their businesses. But I still think the cons outweigh the pros here just based on the capital intensiveness and the low margins of their businesses.
What does draw people into investing in the airlines? I mean, you can make a lot of money if you time it right. And do some people just love it? Is that what it is? They just love the romance of air travel? Well, there's not so much romance in it now.
I think there is a fascination with air travel, certainly, and there are probably some people that like to buy those stocks because of that. But I do think if you get the timing right, to your point, if it's in an upcycle for economies and consumers aren't worried about penny pinching, travel stocks can do very well. And that's when the airline stocks will do well. But you got to predict the economy more than you're choosing a particular company within the airline stocks.
All right, let's move on to an email from Colin. I would love your guests' thoughts on the defense sector. It seems like a great opportunity, but I'm worried about the ethics. Well, that's a balancing act there, isn't it?
It is a balancing act. And we like the defense sector for a number of reasons, starting with the fact that countries around the globe are spending more, partly driven by the fact that they appreciate that national security and the U.S. dynamics are evolving. So a lot of countries are spending more dollars on defense, including countries that haven't spent more in a long time. So that's a big positive backdrop. The other big positive backdrop is defense is changing. We are no longer just about manpower and troops on the ground. It's more about AI, more about technology, more about drones. And that's a different type of defense spending and also a very high cost type of defense spending. So there's some big secular positives to like defense stocks. But to your point, there is ethics and geopolitical dynamics that are at play because at the end of the day, we are talking about impacts to humanity and we're talking about impacts to people's livelihoods. And that is a challenge, particularly if defense is used the wrong way.
Are there ethical sectors in defense? I know that sounds contrarian, but is there a way to, are there any opportunities to invest from an ethical point of view when it comes to the defense sector?
I guess my comment on that would be that increasingly it's less about troops on the ground and the precision of defense is improving. And so what I mean by that is you can be much more, when they deploy defense-related activities, it can be much more precise and much less human-intensive when it comes to having troops on the ground or even impacting livelihoods. Now, at that same time, we know it's not perfect. And we've already seen examples with the most recent conflict where lives have been lost. But I guess on the margin, you could argue that companies are increasingly trying to look at ways of minimizing loss of people and being more precise in how they deploy defense and the precision of the technology.
And does any one country stand out over another?
From my perspective, not really, but that's not my expertise.
Okay, let's get this last email in. It's from Lisa, looking for some advice on the retail sector. Should I buy Canadian or global? Well, you should always shop Canadian when you can shop Canadian. But when it comes to the retailers, how do you look at that? How do you approach it, Nate?
Yeah, the retail space is a tricky space, similar to the airline space, because it's at the whims of the consumer in this case, right? And certain things are in theme and certain things are in vogue when other things are out of vogue. And so you have to be on point when you're a retailer when it comes to having the right products at the right time for your clients. And I think that's a tricky aspect. And we've seen a lot of retailers misstep from that perspective. What I would say in the retail space, what we like most, particularly in a world where consumers are pinching, when there's higher inflation risk, stick with the retailers that have very efficient supply chains and stick with the retailers that are focused on delivering value to their consumer. And we know who some of those names are. You think about the Walmarts of the world, the big club folks as an example, the dollar stores as an example. Canada has a great one that I'm aware of. And so there's a number of spaces where I think you can find good value and well-run types of retail, but you need to focus on ones that are on point for the theme that consumers want and are providing true value in the lowest cost way when you have an environment like today where there's higher inflation.
And is this a sector where sometimes bigger is always better, or are there smaller ones that you can find all those traits that you like?
I think on the whole, scale matters a lot here, but that doesn't mean there aren't niche players that have truly differentiated products, and you can find those. So I think it's a little bit of both, but I would generally say, particularly in a world where margins are tight, consumers' pockets are tight, you do need to look at some of the bigger names that have scale and efficiency.
All right, have to wrap it up there. Perfect timing, Nate. Thank you, as always, for joining us.
Thank you.
Nate Tufte, CIO and Senior Portfolio Manager at Manulife Investment Management. Andrew Bell's up next with the Open. Trading gets underway a little more than 30 minutes from now. Have yourself a great day.